Right, ladies and gentlemen, it is that time again to have our live trader strategy meeting. This is where we all come together and talk about some of the things that we're seeing in the market, some expectations, some review, and who better to bring in than to kick things off than chart trader Brett Manning. Brett, welcome aboard.
Hey, Jim, how are you?
I'm doing all right. How are you, my friend?
I am on the way back. I'm starting to feel a little bit better, but I still have if I cough and splutter a bunch, you'll just have to forgive me.
Well, no need to wear the mask though. At least you are remote here, so
Right.
you're all good. We're all safe. So anyway, with that said, Brett, we had a big number today. How big of a game changer is this?
Yeah. So I mean, so we're already coming into the part of the process where when people are looking at the annual rate of inflation, there's a comps hill that we're climbing because when things really started to kick into gear with inflation about a year ago, and so we're there's already kind of a tailwind there in terms of year-over-year change. And now the month-over-month data is inflecting when there's a lot of tightening already in the system. So I think the market is starting to look for this to be a pretty sharp shift in the inflation picture, and I think we're seeing that in terms of how everything is going today. And of course, the interesting thing about the whole setup here is yesterday and the when this crypto and I know Gavin's going to talk about the crypto crash side of things quite a bit, but it's amazing how this happened over the last few days coming into this, because it's really just sort of the perfect risk reversal for kind of maximum pain for shorts and flats. We had a boom in small trader put buying yesterday, and you had that kind of sense of this sort of implosion going on underneath the surface and all sorts of things. And what I bought today, the ARK Innovation Fund, ARKK, has been out of favor forever, but yesterday was just like a new multi-year crash move. And I think there's kind of some cross pollination with what was going on in Bitcoin, but it really set up this sort of, that instrument is kind of dead center ground zero for long duration growth, and really that's the most interest rate sensitive part of the market. And you have interest rates just going off a cliff today, the day right after basically it just emptied its guts out. So it's
Hmm.
really setting up that kind of that shift that's going to be very difficult to not have some real follow through. Um, and the other big factor that I think is really kind of put in play here is a few months ago I said I was looking for the dollar to turn sometime as we got around the Thanksgiving period. That's about 12 months after the Fed pivot, when they first started hinting. I think it was Daly first started hinting, that the pretty much that transitory was over as a theory. And that's when the Fed put left the picture, and we really started in spirit. We started this bear market just about a year ago, Thanksgiving. Um, and here we are now coming where you're going to have these more difficult comps, and you're getting this a lot of tightening in the system, this month over month inflection. I mean, the annual rate of inflation looking 12 months forward based on month over month numbers in core just went from 7.2% to 3.6% in a month. So like it's a really big shift. And we've got a lot of tightening still sitting in the system, so people are probably going to get relatively confident that the inflation picture is going to start changing. And that's the dollar, right? I mean, that's everything has been sort of inverse dollar one way or the other. We get these dollar declines, risk rallies, and the dollar is breaking a major range level today with this move. And the way that I've set that up over the last few weeks, I did not find the perfect way to implement the emerging markets idea. And I went through about 60 different ETFs and I didn't find anything. I really think there's just an industry failure there to provide a really good trading product that represents what I'm looking for in terms of emerging market exposure, because everything just ends up being Taiwan Semiconductor and Alibaba pretty much.
Hmm.
And you can find I could have bought Turkey and Brazil and South Africa, maybe that would have been sort of combining different ideas. But I needed something on, so I just put EEM on. But it's still going to be a really good inverse dollar kind of play. And then silver, which is just really sort of leveraged gold. And both of those are moving really well. And then with the addition of ARK today, if this is a major inflection in interest rates, everybody's already left that thing. So there's a lot of room.
All right. So I know you had some thoughts in the crypto space and what's going on, Gavin. I know you've been out of it a little bit, but I know you've been able to play a little bit of catch up. So, well, what were your thoughts as far as what was going on in that?
For the crypto space, I mean,
Sure.
basically the way I look at it, there's obvious. It feels like a Lehman moment for crypto, and I guess the question is, in the Lehman moment, a lot of people were just kind of looking at, oh, this is just a little bit of housing data, and how much exposure could everybody have to it? And I feel like that's kind of what's going on right now in crypto. People are trying to figure out exactly what the exposure was when you take a look at what happened there. Basically, you had FTX was lending out its investors money to Almeida, which is their trading platform. And it just kind of harkens back to, a lot of the Dodd versus Frank argument about trying to separate traditional banking units from trading units. And there's a lot of similarities going on there with what happened with FTX. And, we're seeing some headlines coming across from Sam Bankman Fried about how much exposure that they had out there. And I think that's kind of what people are trying to figure out, exactly how leveraged they were. He's saying that they were only leveraged about 1.7 times. But some of that doesn't necessarily make sense in terms of how quickly a lot of those trades started to fall apart. So I think what you have is those headlines the last few days are certainly weighing in against the markets, just kind of seeing that big risk asset falling apart, and people were just simply uncertain how many other loans had been leveraged based around those fixed assets, and that just led to a sell now, ask questions later move. But like Brett was saying, perhaps a lot of that might have been more of the retail space that has been, trading a little bit closer to what Bitcoin does, and just kind of following that along as a harbinger for the rest of the economy. And that led to a little bit of a washout of the retail trader, which is one of the steps that we kind of need for a bottoming process to come out. The other would be is if Bitcoin, the asset class, did have a big washout, and a lot of that money was taken out. And that way, the markets would have a better idea of the emperor without clothes, if you will, where who are the big houses that weren't really involved with that, and who are the small houses that are blowing up, and let's try to avoid that. Something like a MicroStrategies that had put so much effort into the Bitcoin space there. And as we get more and more answers on that, I think that Bitcoin will prove to be a little bit less of a bigger macro concern, and that would be one of the key things that we need to watch here. How's the market going to react to that? I think, as Brett pointed out, it seemed like it was a bit of a head fake down lower the last couple of days, and the CPI report could certainly overshadow some of the moves that we've seen down lower because of those Bitcoin concerns. So it's a really interesting backdrop to have in the market. It's another degree of difficulty that the market doesn't necessarily need right now. So we'll continue to monitor this, but I think the bigger item is that reaction that we got in the CPI, and Brett was talking about a little bit of a sea change in the expectations around CPI. And we kind of started seeing that last October, on October 13th. We had that big crash going down to 3,500 in the S&P, and then we ended up ripping higher by 5%. And it feels like that could be, on hindsight, perhaps the peak inflation moment. And now we're just slowly going to get more and more data that builds off of that. Today's report was certainly a positive, where we're seeing a bit of a slowdown going on in the broader market. Certainly, rent remains probably the primary concern, but just anecdotally speaking, people could see some of the cooling off in prices, just from what we've been getting from earnings calls, and just some of the other data too that we've been seeing. So this is all pushing the right direction. We saw a lot of the expectations around the Fed start to cool off. So, that'll definitely be a tailwind for asset classes as we go into the end of the year. So, basically, from my perspective, as I've been saying, is I'm looking for that bullish rally into the close, a lot of FOMO trading from people, and for that to catch up. And then the beginning of next year should be pretty interesting when I think we'll get some more of the recessionary data coming in, and perhaps a poor Q4 from a lot of these companies. And, that might lead us to the final washout that we need to see in this current bear market. But today's CPI number was definitely a positive. I think that it should help overshadow the issues going on in Bitcoin and crypto. But again, I want to see some more of the fallout just in terms of third party risk, because that's going to be the key aspect. And once the market has a fair idea of what kind of size of impact this is going to be, then they'll be able to step forward. So I don't know if Craig or Damon have any thoughts on the crypto and if they agree or disagree with my take there.
I'm not sure we have Damon on. He's having some internet issues. We'll see if he can get that one worked out. However, since I have both Brett and Gavin on right now, I want to talk a little bit about where we are as far as positioning. Now, I know you guys will do your sentiment and flow show, but we had an update from the AAII with the investor sentiment. And we saw a big pickup in the bearishness and a drop in bullishness. So, how much? I guess if you could
Test.
quantify.
I hear you,
Heard
Craig.
ya.
Okay, I'm in. Sorry, I had the mic muted. Yeah, no, I mean everything Gavin made sense. Everything Gavin said made sense. I mean, I'm not. Obviously, the weakness in crypto came at a really bad time this week as there was angst going into the CPI print. Everything was kind of in free fall. So if the dollar peaked and rates can cool off because we can see a pause or a slowdown here coming, then perhaps we'll see this year-end rally. It's hard to get really bullish, even though the inflation comps are going to be pretty tough. So you would think inflation is going to be able to kind of level off here in the coming months. But there is I think a record amount of tax loss selling in the queue here over the next couple months. So things are going to remain tricky for sure. When it comes to crypto, I don't think anyone is. I mean, the news this week was pretty shocking because this FTX was supposed to be the new leader. So it does seem like a competitive win for sure for Coinbase, but the valuation still seems pretty tough to defend. So if Bitcoin bottoms here along with the rest of the financial markets, then perhaps coin is a good buy here, but I still am largely bearish on it. Sorry for interrupting you, Jim.
No, that's all right. Glad you're able to jump in. So anyway, let's revert back to the AAII investor reading, and I think Gavin had a good point today that if it was taken today instead of yesterday, this might have looked completely different. However, how much do you think this was a function of what we saw this week in the crypto space versus an overall positioning? I mean, was Brett? Have you ever been able to calculate an actual correlation to positioning versus kind of just a mental state? Does that question make sense to you of what I'm trying to get at?
It makes the most sense that anything could possibly make, Jim,
Okay,
because
good.
that's exactly what we were doing. Why we have the sentiment and flow show. Like the whole reason to look at sentiment data is to jump across that bridge from how people are feeling to how they're positioning. Like that's why sentiment data is interesting. And it takes it's an art, not a science. I'm not going to give you a formula, but my experience is, and this is when Gavin and I talk about this this survey in particular. There's this word that I use. I'm not sure if it makes sense to everybody, but the word to me is festering. When it festers at an extreme, when you start to get like the 4, 5, 6 week moving average being under a key long-term threshold, when there's a long period of people saying the market is going to be worse a year from now than it is today, and that happens over the course of a month or two, then I think you start to read through into like there's a dramatic shift in positioning that's happening when that sustains itself over a period of time. And you can see it in other indicators too. You see the way people are positioned. You see portfolio managers carrying lots of cash. You see everybody owning lots of puts, put premiums, getting paid in records. And then you see survey data that kind of mirrors that sense. And there's no doubt, people are people have been moving to a very long-term pessimistic kind of view of things. And there's no point in trying to understand why, but you just understand that it's true. And one of the ways that I look at this is that doesn't necessarily mean the market's going to rally, but it does expose it to the vulnerability of rallying when you get a situation like that. When you clear some uncertainty out and something about the world just starts to look a little bit different to people, suddenly everybody realizes everybody's super offsides in terms of cash and puts. And this last week was interesting to me because we'd been in this state. I mean, you could see this week over week on the AAI data is big, but it's also even when we're at last week's data was still historically bearish.
Mm-hmm.
Like that was already that's the high point, but it's still that was like, well, less than the long-term average of bulls, more than the long-term average of bears. And that was the bump up. But if you look at the weeks before that, you're just festering in that sort of 20 to 25% bulls area. We were up to 56% bears in mid-October, and now we're close to 50% as of yesterday. So it's festering in historically abnormal levels of bearishness for weeks and weeks and weeks. And then the crypto crash and, seeing like, Amazon. And I mean, this was kind of besides the crypto crash, this has also been the period over the last, let's say, week or two where you have, really the big bear part of the market is the tech mega caps. It's Amazon and Microsoft and Google, and like these are the the superstars of the last decade. And this is when that retail money is just emptying out of the market. And then you get the crypto crash on top of it. You get the crashing in like XLY, consumer discretionary. I mean, a lot of Amazon there, but still, new bear market lows, big gigantic down bar yesterday. ARK, kind of the ground zero for speculation and as I said, long duration growth. Big crashy bar down yesterday, right in front of this game changing CPI number that even the Fed was caught off guard by. I mean, Harker came out today. He's been a hawk. And suddenly he's talking about he thinks that they should pause at 4.5%, which is under the Fed funds cycle terminal rate. Like he's now a dove, a hawk turned into a dove relative to any objective standard. So like the Fed was caught off guard by this.
Well, and that's almost crazy just based on the fact that it's one data point. Don't you think? I mean, for him
It
to
is,
change
but
his
it's a
mind,
it is one data point, but it's also in the mix of we've got a lot of tightening already built into the system, and the month-over-month change is going to become like I saw a good piece by an analyst put out something like think of it like a golf scorecard, and whether you're above par or under par each month, and if we stay at seeing like core advance by just what it did today, if that just becomes sort of normal, the Fed funds rate they don't even need to hike again, really. I mean, like it's just we're going to naturally transition to where the Fed funds is already at CPI by March without even hiking. So do they want to crash the economy or not? They're starting to probably think that they may have a soft landing zone here if they don't overdo it right now, because there's a lot of tightening already in the system. And again, you've got this sort of year-over-year comps issue for inflation that's going to help. Supply chains are opening up, et cetera, et cetera. And maybe there's that sort of he said, she said kind of China situation on their COVID restrictions. That's another possible headwind for inflation picking back up. So they're in an interesting position right now. And I get what you're saying. It's one data point, but it was a big data point. And there's context that suggests, already there were a lot of sort of headwinds building up for inflation.
And Brett, I'd also just kind of build off of that on terms of the reaction to last month's CPI, where again we got crushed right off the base, and then everybody jumped in.
Yeah, the market is seeing it. They're seeing around the corner.
Exactly, and that was on undoubtedly a horrible report in terms of everything was up higher. This was, it's still high year over year, obviously, but there was some some bright lights in there, some lights
Very
at the
much
end of the
so.
tunnel this
Yeah.
time around. And so it's one data point for sure, Jim, but it is the second inflation report in a row where we've seen a pretty positive reaction, and that just works its way into market sentiment, of course. And then we'll have to keep an eye out on the U of M long-term outlook. There was a speech earlier in the week from John Williams, the New York Fed president, and he laid out a number of the longer term data reads, which I'll post it later. Brett, I don't know if you had a chance to take a peek through it, but he went through all the ones in the PCE and a few other long-term outlooks. They've all remained stable, and that's kind of the key item for the Fed here.
And the 5-year break evens.
And the
2%.
5-year break evens, exactly. So, we'll keep an eye out on that. We had a bad auction yesterday, of course. So, kind of watching these auctions and how they function will be something worth keeping an eye out on too, of course. But this was the second positive response to a CPI report we've seen in the last 2 months. So there is a little bit of a sea change going on in there.
All right. Want to check in. Is Scalp Trader on board with us?
No, it looks
Or is
like
he
he's
still
having
having some
technical
problems?
issues. Yeah.
Okay. All right. So unfortunately, it doesn't look like we'll be able to get to him. All right. Let's get some ideas out there.
Well, what one thing that I wanted to talk about, and I know Craig, you were mentioning this earlier, is we're in tax loss selling season, right? And I'm curious because I have a dilemma. I've got a number of my accounts in Amazon, and I've been kicking back and forth what I want to do with it. It's a long-term hold, but I am looking at it as possible tax loss sale. But then you get a move like today. So I'd be curious to throw out to the team for tax loss selling. How do you kind of look at some of the actions that we've seen in some of these names that probably would have been prime candidates, like an Amazon, like a Meta Platforms? That's starting to get stronger because if you do the tax loss sell, you can't get back into the position for 30 days. So I'm just kind of wondering, are people of the mindset like, maybe I won't give it up, or I'll still go ahead and fire on with the tax loss selling? So, Brett and Craig, do you guys have any thoughts on that?
Personally, I wouldn't try and get you cute if you still do like something like an Amazon long term. I wouldn't be tax loss selling in here. I'd rather just continue to accumulate it. Um, I feel like more, it's different. I guess it's different between retail or more of a hedge fund, but, I think there's a lot of bags that retail is holding that, that people are kind of sick of holding on to, and they will be looking to dump into a bounce. Where, at least personally for me, even if Amazon has another quarter or two where they need to get the expenses down, I mean, I think most people would agree that the weakness, it's trading at a pretty reasonable free cash flow multiple now. It's like 12 times. I would just rather buy it while it's out of favor than, because if the market does rally here into year end, or, if inflation helps and all of a sudden it's up big from here and then you kind of missed it, right? If you still like it long term. So,
Right. So if you're buying it here, you just have to accept that there might be a little bit of a short-term headwind from the tax loss selling, but you'll be able to fight through. Is how you figure it.
yeah, I mean, if you like it long term, then this weakness is opportunity. So, I mean, it's down almost 50% from the high, and even if your expectations for next year are more muted, and the stock will, I guess it depends on how patient and how active you want to be. Where, yeah, more, there might be some professional money that is confident that next year will be more flattish, and they can take the tax advantage here, and they'll be able to buy it at some point next year. I mean, that's perfectly reasonable too. I guess it depends on how active you want to be.
Brett,
I
you
have a
got any
question.
thoughts?
Well,
Uh,
I have a quick question.
yeah.
In terms of the timing of tax loss selling, what have you generally seen as the time period over what span? Probably like a 2-week time span beginning in December?
No, it's usually earlier is what
Mm.
I generally see. Certainly, I feel like probably a lot of people wait for the Q3 earnings report to get passed and then kind of figure it out from there is how I generally see it unfold. But I mean, like I said, you got that 30-day period that if you sell it, you can't buy it back in that time frame. So it has to be before December 1st, given that criteria. And usually it's end of October into Thanksgiving, I would say, is when I think we see the bulk of the tax loss selling.
Okay, so that could spur some volatility over the next couple of weeks. So we'll have to be on the lookout for that as well. Do you
Actually, I do have one thought. I got one thought
go ahead?
on this. So there's
Yeah,
this metaphor.
give us the game theory, Brett.
Oh, well, I'm going to give you the rubber ducky bathtub
I love it.
because prices don't really. People think of the market like I have a problem with all these sorts of theories. So people think of the market like wrongly, like a physical system where there's where there's a like a drain and a faucet, and like the faucet is the buying and the drain is the selling, and there's a level of the water. And if you imagine a rubber ducky floating on the bathtub surface, if you pull the plug but you don't turn the faucet on, the rubber ducky goes down. And if you plug the plug back up and you turn the faucet on, the rubber ducky goes up. And you can look at that like a metaphor for how much selling is coming in versus how much buying is coming in. But the reality is the market it feels like that's what it is, but it's really not, because any transaction is negotiated at a price. And there could be very little selling or very little buying, but the price that people agree upon to transact at is what sets the market, not the total number of sellers or the total number of buyers. It's not this physical force pushing back and forth between buyers and sellers. We think of it that way, but that's a flawed heuristic. The market is an auction. And if people like where this market is headed, it doesn't matter how much tax loss selling comes in, because that will just be an opportunity for somebody else who's going to be buying it if the price were to move lower. So if the amount of sales of shares that are being offered in the market moves the price down, it will be below the price where people think that it should be, and there will be plenty of buying there. So it doesn't necessarily mean the market's going to go down just to say that there's a record amount of tax loss selling coming in.
Well, good point there, Brett. I'm sure, though, that what we're going to find is we'll have a ton of questions on our feedback about a shopping list of what would be good tax loss selling stocks that you guys are going to be looking at. So, have you guys generated any type of list like that? Because it's coming.
Yeah, I've started putting together. I'm annoyed because I had a good note somewhere buried that I had to go back and check out. So still looking for that. But I mean, a lot of these mega cap growth names, obviously Amazon, Meta, they've been getting killed. Roku is another one that I had on the tax loss selling list. Caesar, CZR was another one that I was finding popping up on some lists. So these are a few of the names that I'm looking at. I'll be putting out a more comprehensive list of it in the next week. But I've definitely been looking at some of the names and putting together a few that I would have on the radar for buying, especially if we get that FOMO rally into the end of the year that I've been calling for.
All right. Anything on your end, Craig?
You mean in terms of as an opportunity tax loss?
Yeah, things that you're eyeballing, because you're kind of a value guy. So,
Well, to me, it kind of goes hand in hand. I mean, obviously, this morning's data was pivotal. It seemed like if we got another hot number, we were going to extend to retest the lows for the year, and everything was in the toilet. Pretty much all of these ARK stocks, all these growth stocks that have gotten clobbered all year, are all, I suppose, candidates. But to me, I just kind of think of things more in terms of the broader macro situation. Obviously they've all gotten crushed, and the valuations have come down a ton. So now, if the dollar and rates have cooled off, we might have a reprieve. I just think of things more in terms of just like fundamentals, whether or not I like it here longer term, as opposed to like a tax loss selling thing. But that's just me.
Okay, gotcha. Now, I did see that you were getting back involved in TTD. That was a big home run for you over the years. I know TTD had their earnings out, and since we have you on the horn, why don't you break that one down?
Yeah, I started accumulating the stock a week or two ago as all these advertising reports were awful, and I knew that it was going to really stand out as the gem in the group, and that's essentially what happened. I mean, everything is just really really positive from their report, except they guided down revenue, which is a function of the market weakness, but it's still something like 25% growth, 30-40% margins. The flood of so they're partnering with retailers pretty much across the board, all the biggest ones. The flood of AVOD advertising supported streaming content from Peacock and Fox and now Disney, even Netflix at some point, which is kind of what boosted Magnite MGNI today, which is up like close to 50% last time I looked. The thesis for TTD has never been stronger. They continue to execute really, really, really well. It just comes down to a question of the multiple and the valuation. It's it's not a cheap stock, but it's a buy on weakness because they're just really, really well positioned and just keep taking share, keep growing. They're growing close to 30% in this weak macro. So if next year is still soft, maybe they only grow 20, 25, 30% again. But when things kind of do recover, um, uh, they're going to be a leader. So it's one of those stocks that's always going to be expensive, and you want to buy it when it's out of favor. I had said yesterday morning, it reversed lower, and I added in the 42 area, and I said I was going to add again at 40, and it basically became a bet on CPI this morning. If it came in hot and the market just extended lower and tanked, then I just didn't want to. I don't know. I was just trying to be a little bit more patient in case we saw a hot number, but basically back to even because I started buying a little too early last week. But yeah, I still have a longer term position from soon after the IPO, and now I have a 3/4 size swing here that I've kind of accumulated in recent days and weeks. So I mean, this is going to be when the market finally does kind of stabilize and start heading higher. This is going to be a leader. I'm definitely one of the higher conviction stocks. Really, valuation is the only question, and the weaker the ad market is, the weaker the economy is going forward, the more opportunity it will be if this stock remains out of favor, in my view, because it's definitely one of the stocks worth buying and holding.
All right. And any other names you want to give an update? AXSM might be one.
Yeah, we finally are seeing some strength here. The prescription data, the second week of prescription data, this drug was launched a few weeks ago, was strong last week, and it sent the stock up like 20% last week. And now it's kind of extended that move. It was pretty encouraging report on Monday morning, basically just kind of reaffirming that there is. Management is encouraged by the early results, even though it's a week or two and it's a little too early. But the stock has kind of gotten back into where there is some resistance here in the 60s. But biotech is a growth sector where it's kind of held up better than information tech or advertising. This stock remains a buyout candidate. This is the first new MOA in depression in like 40 years. If they can pull off a successful launch, they also have some Alzheimer's agitation data expected before year end. So that could be another catalyst, positive or negative. Don't have necessarily a strong opinion on it either way. But if it isn't positive, it's not the end of the world. I'd view it as an opportunity because they're already planning. They already have another trial. It's not like this is make or break data on the Alzheimer's front. And it's a $2+ billion market cap that could easily get taken out at a much higher price here if we're patient.
All right, Gavin, I think you had another question for Craig regarding Robinhood.
Yeah. Just looking to throw out a couple of questions to the team here. And Craig, I know you're talking about Coin and them being a potential beneficiary with FTX falling off since they're competitors. I know that you're still bearish on it, but was curious as to your take on Robinhood because I believe Sam Bankman-Fried has a pretty big ownership position in Robinhood, which I assume they'll have to sell off in order to make some of their customers whole. So I was just kind of curious if you've been following that story and if you're trading Robinhood at all, because I know it's a popular one on the site.
No, I haven't really looked at that one. I mean, I'd have to, from a valuation perspective, I guess it's not egregiously valued like it used to be. If you compare it to the traditional brokers, what the traditional brokers are trading like 15 times earnings, 20 times earnings, maybe 25 times. These guys aren't really forecasted to make money in the coming years, and then blow off the top from all these users all these younger users they took in with free stimulus checks last year. Coin and Robinhood are kind of similar to me in that way. I mean, I didn't take a really close look at the last report, but I would assume that their user growth story isn't.
They lost 1.2 million
Right.
subs.
So
Robinhood last quarter.
So to me, if they were still growing users and this was like the next up and coming broker, it would be more exciting, and maybe it will remain that way for your average teenager or college kid that's getting in the market. They're going to use that. I feel like it almost serves as a platform to, once you start taking it more seriously, you'll move over to name another broker, E-Trade, Schwab, Ameritrade. So without a sustainable, they're not really making money, and they're not really growing users. So I don't know, unless that changes, it doesn't seem that attractive to me. I mean, it seems like they have taken some action to kind of cut costs and rationalize things, which is good. But that boom that we saw last year, or coming out of the pandemic, a lot of people are probably just like licking their wounds. So I don't know. I don't really like Robinhood very much myself.
Yeah, no, I'd be more looking to lean on this bounce as well. I agree, especially if there's potential for a big seller in there.
Yeah, I don't see what like, maybe they could have been considered maybe it is a takeover candidate at some point. I don't know if it's really worth brokers to like buy their book of business. It's a bunch of like smaller accounts without a lot of money. Yeah, I don't know.
Yeah, that makes sense. Brett, I had a question for you on a Wall Street Journal article that was out where
Okay.
basically next week the New York Fed holds their annual meeting, and one of the things that's supposed to be coming out is regulators are talking about broadening the amount of companies that could take place in bond buying. We obviously have the primary dealers right now, the group of 14 banks, but they're talking about expanding that and creating an exchange. Their primary concern
Mm-hmm.
is around the liquidity that's
Yep.
going on. And certainly we've seen plenty of that with rates over the last 2 years. Now, I get it that there's a pandemic and everything with the Fed moves and all that, that's on a historical basis. But they've had a lot of concerns about the liquidity and just small moves really kind of providing outsized pushes on yields.
Right.
So
Right.
I was kind of curious. Now, this would be a couple of years off, but that is going to be one of the things that they're bringing up. And I think it's going to be something that markets are going to be looking at closely.
Right.
How do you see that impacting the broader bond market? Do you see that kind of changing anything in the backdrop of the plumbing for fixed income?
Well, I mean, first of all, the context for them making that decision is pretty clear. I didn't see the article, but I can imagine. You do quantitative easing, you're removing bonds from the market, right? You're putting them all on the Fed's balance sheet. Quantitative tightening, you're not selling them all back out there. You're just letting them mature. So it's just disappearing. So they mopped up all these bonds, put them into a freezer, and now they're letting them disappear, rather than replacing them. And at the same time, if we have an inflation problem and you get, people don't want to buy bonds in the first place, then, the government has to fund itself somehow. So you've got this fundamental conundrum. And one of the ways to increase liquidity is to, make trading more accessible, make there more market participants and an easier platform for participating. You'll increase liquidity. But ultimately, I think that, the inflation is going to be a big part of this story. Like if you have, it almost makes it seem like a recession would be a welcome thing for them. Like you want a lot of people wanting bonds, and the government can put a lot of new bonds out there, and there will be demand for them. But you've also got problem in foreign buyers too. So yeah, I mean it's sort of they're looking at like if they want to do quantitative tightening over the course of this period of the next few years at some points, this is going to be a fundamental conundrum that they're facing. Like, how do they make sure that the bond market's able to function in a normal way?
Yeah, and I mean, it's either this, I suppose, or expanding the capital rules for the banks, which we know Jamie Dimon would prefer that.
Right. Yep.
That'll be another interesting impact. Those banks with big fixed income trading desks, how does it impact them
Yeah,
being
and
able to do
ultimately,
these
I
things?
tend to think an issue like this, like there's going to be a solution. They're going to get a bunch of smart people around the table and figure it out. I kind of feel. I don't. I know there's a lot of people like, hey, the next crisis is coming. The bond market illiquidity implosion, and I guess it's not completely impossible. And there's going to be moments, like if other things, if you get a perfect storm of different variables kind of coalescing, like we saw in the UK. Like they had an illiquidity driven bond market crash in a manner of speaking, because they had this other source of sudden and necessary and price inelastic supply come into the market in a short period of time. So like it's a vulnerability, and you've got like a bridge that's made of rickety wood, and if you try to put an elephant across it, it's going to break. But we can gradually shore up the quality of the wood on the bridge over time by making important and interesting decisions. And it also wouldn't be good to put an elephant across it, but it's a problem probably that's going to be more theoretical, in my opinion. We'll see.
One quick headline I'm seeing out there, Jim just thought the people, looks like Biden and Xi are going to be meeting Monday on the sidelines next week at the G20 conference. So it's certainly something for us to watch. Do we still have Jim there?
Oh, yeah, I had my mic on mute. Wow. What do you know? Fumble. Anyway, Damon isn't able to join us, but he did send me a comment here. And he said just about every commercial and mortgage REIT conference call that he's listened to this quarter have said this is the most favorable lending environment for lenders that they've seen since the great financial crisis. So he goes on and he thinks the preferred stocks offer a very attractive opportunity. He has posted a few new ideas. In fact, he posted one earlier today, and that has over a 9% yield. So I do think that that is something that you should check out. When I post the replay of this, I'll put his comments on his little tag under Scalp Trader, just so you guys have that. But unfortunately, he had some internet issues and wasn't able to jump in with us today. Anyway, fellas, is there anything left that we need to touch on before we wrap things up here?
I mean, from my perspective, I think we've covered most of it. I mean, I really haven't changed my mindset too much. Certainly, while I was gone and just kind of looking at the movements going on in Bitcoin, it gave me some cause for concern because any rally is going to be a house of cards given the amount of headwinds that are out there. But this CPI data definitely is a step in the right direction. We got U of M tomorrow. Next week's meetings with world leaders, that'll be something for us to keep an eye out on. Do we get some sort of resolution to the Russia Ukraine situation? That would be a big positive for the markets, certainly for the European markets. I think that's where you'd see a lot of money flowing into. So these are a few things that we could start getting a little bit, I don't want to say closure to, but perhaps some pushes in the right direction. So, with that in mind, we continue to follow the data as it comes out. But if the bad economic data is going to be a positive for the markets, then that's one other tailwind there. And I think probably more importantly, the reason why I see us getting a little late year pushes, a lot of money managers out there, portfolio managers, underperforming the market right now, that if they were a little too bearish and sitting on the sidelines, if we start edging up, they're going to have to rush in here and start buying things. A little bit of a FOMO melt up into the end of the year. And as long as this crypto business doesn't explode and show some signs of really seeping into other asset classes, I think that I'm still sitting on that outlook for right now.
And I just point out Fed's daily just out, just to kind of pile on the theme here today. Daly is the one who was the, transitory is over comment almost this time last year, maybe 50 weeks ago, right before Thanksgiving, I think it was. And now she's out saying that the time is now to step down the pace of rate hikes. So it kind of piles on more of the theme that we saw from ARKK. And she, of course, is generally seen as somebody who's speaking for Powell. So another push in that direction.
All right. And also, hopefully, we'll have a little more clarity as far as where we stand on the midterm elections. And we'll have that, hopefully,
Jim,
another one that's checked off the list. Go ahead.
I think the midterm elections are off the books already as far as traders are going. I think that barring the Democrats upsetting and winning the House at this point, the market just wanted gridlock, and I think that they got that, and they didn't want as big enough of a win for the GOP that the debt ceiling debates for next year were going to be a real possible headwind. So for me,
So
I
you
think
mean it was Goldilocks gridlock?
a Goldilocks gridlock is how I see it.
Right.
I think you got Biden going into these meetings next week with a position of strength. Now, I mean, if he took a drubbing in the midterms, she would just go in, look at him, and be like, "You're going to be gone in 2 years. Why am I even talking to you?" I don't think he could do that now. So yeah, it was Goldilocks gridlock as far as I could tell. Brett, do you have thoughts there?
No, I would agree with you.
All right. Well, if that is it, fellas, we will wrap things up. And I appreciate you guys jumping on and giving us some color, some ideas. And we'll do this all again next month. I want to thank everyone for listening and thank you guys for joining in and your commentary. And I'll get this replay up as soon as possible. Thanks a lot, gentlemen.
Thank you, Jim.
Thanks, Jim.
Thanks, Jim.